Hello, everyone, and welcome back to Gold Off the Charts. A bit of deep financial insight every day to help you stay ahead of the pack and navigate the road to wealth with confidence. If 2025 was the year we saw cracks in the global asset system, then the first week of 2026 finds us standing directly in the eye of the storm, watching the old order collapse as a new one takes shape. The sheer volume of news and the breakneck speed of the markets lately has been nothing short of explosive. From the lightning-fast regime change in Venezuela to the Trump administration's bold moves toward Greenland. In the Arctic, every geopolitical signal is screaming the same thing. The world of stable inflation and peaceful growth we once knew is gone for good. But if you've been watching the charts, you'll notice things aren't exactly following the usual script. Not only did U.S. stocks hold firm last night, it felt like a rave on Wall Street, with the Dow Jones even hitting 49,000 at one point. Meanwhile, gold, the king of safe havens, is still trading at highs, but seems to have hit the brakes, hesitating just above the $4,400 mark. So, what's really going on under the hood? Is the drama over? Or is this just the calm before an even bigger storm? Today, I'm going to break down the two massive undercurrents surging beneath the surface. First, the way Wall Street is repricing geopolitics, and second, the forced selling pressure hitting the precious metals market and the irreversible super cycle behind it. Most importantly, I'll show you how to position yourself once the dust settles. This is a game of perspective. Grab your coffee, take a breath, and let's get started. Let's look at the current market reaction. Last night, U.S. markets were electric. The Dow Jones crossed the 49,000-point threshold for the first time intraday, and while it pulled back slightly at the close, that all-time high is very real. This is strange. On the surface, the U.S. just used military force to arrest a foreign leader. Geopolitical risk is clearly through the roof, so why is the stock market treating this as a win? It comes down to a core financial principle called the exclusion of the worst-case scenario. For capital markets, the biggest threat isn't bad news, it's uncertainty. Before the U.S. acted, or the moment the operation began, what was the market fearing? Investors were worried about a long, drawn-out conflict. They feared a total collapse of global oil supply chains or Russia and Iran getting dragged into a world war. Those were the big unknowns that caused the initial panic. However, once the U.S. asserted control with thunderous speed and began coordinating with big oil companies to stabilize the market, expectations shifted instantly. The market decided the worst-case scenario, total regional chaos, had been avoided. Financial markets are now rapidly pricing in or digesting the impact of this military move. Current sentiment shows that risk appetite is back. Wall Street traders seem to have developed fatigue when it comes to geopolitical headlines. They are no longer willing to pay a high premium for doomsday scenarios. Instead, they are pricing in a soft landing for this crisis. Since the situation is contained and oil is flowing, the party continues. This is why U.S. stocks are climbing while gold's rally is stalling above $4,400. The short-term fear trade that drove gold up is cooling off fast. But here's the kicker. If you think gold is struggling just because the panic has subsided, you're only looking at the surface level. What really concerns me in the short term, and what I want to warn you about, is a wave of mechanical, unavoidable selling pressure coming from the futures market. This is a professional insight that many retail investors miss, but it will dictate price action for the next 2 weeks, the annual rebalancing of the Bloomberg Commodity Index. If that sounds complicated, here's the plain English version. The BCOM is the global benchmark for commodity investing, much like the S&P 500 is for stocks. Massive passive funds, ETFs, and institutional portfolios track this index. As of last October, nearly $1.09 trillion in assets were tied to it. This index has a strict rule. It must readjust its weights every January. This year's adjustment is a direct hit to precious metals, specifically gold and silver. Mark your calendars for January 8th. During a 5-day rollover window starting then, the index will be forced to sell off a massive amount of gold and silver futures contracts. How much? The numbers are staggering. We expect roughly $6 billion in gold futures and an even more dramatic $5 billion in silver futures to be forcibly sold. You might think, is $6 billion or $5 billion really that big for a global market? For gold, which has deep liquidity, $6 billion can be absorbed, likely resulting in just a standard pullback. But for silver, which has a much smaller market cap, this is a financial tsunami. According to Bloomberg, silver currently makes up 9% of the index, For 2026, that target weight is being slashed to just under 4%. That means nearly half of the index's buying power for silver is being cut. Strategists warn that positions equal to 13% of the total open interest in COMEX silver will be dumped in the next 2 weeks. Guys, this is purely mechanical selling. It doesn't care about fundamentals, geopolitics, or golden crosses on a chart. When the clock strikes, the computer simply hits sell. That's why I'm saying gold and silver are facing a short-term pitfall. The combination of cooling tensions and tens of billions in forced selling is why prices are shaky right now. Does this mean the precious metals bull market is dead? Not even close. In fact, thinking that would be a huge mistake. The most important skill in investing is telling the difference between noise and the trend. The Bloomberg rebalancing is just noise, a temporary price distortion caused by technical rules. The real trend is found in the macroeconomic big picture. I can tell you with certainty that despite this selling pressure and the stock market bounce, gold is still in the middle of an unprecedented super cycle. With such strong fundamentals, the impact of this selling will ultimately be short-lived. If you understand this, it isn't a risk, it's a gift. This is likely one of the last great opportunities to buy the dip. Why am I so confident? Because the 3 pillars supporting this bull market haven't changed, they've actually grown stronger. The first pillar is the irreversible trend of de-dollarization. Look at Venezuela. The US may have won militarily, but it took a hit to its global credibility. Every time the US uses the dollar as a weapon or for long-arm jurisdiction, it erodes trust in the currency. Central banks aren't blind. They are watching this closely. We've seen central banks buying gold at record rates. This isn't speculation, it's survival. They are swapping depreciating dollars for gold because it has no counterparty risk as a reserve asset. This nation-level buying creates a floor for prices. As long as the dollar's credibility is in question, which it likely will be for a long time, this buying spree won't stop. The second pillar is the joined-at-the-hip relationship between geopolitical conflict and economic decline. Don't be fooled by a short-term stock rally. Look at the real economy. Europe is flirting with recession, and emerging market debt is skyrocketing. When economies struggle, tensions rise, leading to conflict, which in turn hurts the economy more. It's a vicious cycle, even if Venezuela stabilizes. What about Ukraine? Or the Middle East? These powder kegs can blow at any moment. In times of chaos, both retail and institutional investors have reached a consensus. You must own gold. It is the Noah's Ark of the modern financial world. The third pillar and the most direct driver is the US dollar's interest rate cut cycle. No matter how hawkish the Fed sounds, the trend is toward lower rates. The interest on US debt is becoming unsustainable. They have no choice but to cut rates, which means real yields will drop. So ask yourself, has de-dollarization, geopolitical tension, or the rate cut cycle changed just because of an index rebalance? No, not one of them. With the fundamentals rock solid, a short-term drop is just a chance to get cheaper chips. As I always say, be greedy when others are fearful. Now, let's pivot to silver, a metal we've discussed many times. As the dust settles from the Bloomberg rebalancing, silver is likely to become the star of the show. I know many of you hold silver and are worried about the weight being cut from 9% to 4%. Yes, $5 billion in selling pressure will make things rocky in the short term. But look at it from the other side. Once that 5-day window after January 8th closes, the biggest bearish force in the market will be gone. It's like a spring being compressed to its limit. When that $5 billion in mechanical selling is finished, there won't be any major short sellers left. At that point, even a small amount of buying could send the price moonward like a rocket. Furthermore, we've talked about how silver squeezes are becoming the new normal. The silver market is small, easily moved, and prone to supply shortages. Demand from the solar and EV industries is exploding, and global stockpiles are being drained rapidly. In 2026, while gold might take a backseat to digest its gains and handle the index rebalancing, silver, after this massive change of hands, will likely lead the next leg of the precious metals rally. Once the index adjustment ends, pay close attention to silver. When the rally starts, silver is often twice as elastic as gold, meaning it moves much faster and further. In this market, most people chase the highs and panic at the lows. But here at Gold Off the Charts, I want you to be the sober ones in the room. When others are panic selling and institutions are forced out by technical rules, can you see the opportunity hidden behind the charts? Gold and silver are squatting right now so they can jump higher later. This dip is the first big gift of 2026. Whether you have the conviction to hold through it will test your trader's mindset. Finally, a quick reminder. This analysis is based on my personal logic and current market data to help you see through the fog. It is not direct financial advice. That's all for today. If you found these insights helpful, please drop a comment and let me know your thoughts. Don't forget to like, subscribe, and hit the bell for Gold Off the Charts. See you in the next one!